Hello and welcome back to Moneycontrol's live stream. You're watching Closing Bell with me, Lovisha, Darad. And the markets continue to remain worrisome at this point of time. We did see that after wiping out nearly 6 lakh crore rupees in investor wealth and plunging more than 1,000 points earlier in the day for the Sensex, Indian equities have clawed their way back and they've staged a sharp rebound from the midday onwards. But yes, the compounding on the pressure, the Indian rupee continues to slide to an all-time low against the US dollar. And since the January 1st, the rupee is already depreciated by about 1.5 rupees itself. So yes, there has been sustained foreign outflows, global uncertainty, which is mounting the pressure on the markets, which is why we are seeing that the markets have been on a downward spiral. Nifty so far this week has already, it's down by about 2% itself. But it's coming to the levels of where we stand. We did break that psychological barrier of about 25,000 mark on the Nifty 50 index. But right now we are back above that level, 25,150. That's where we are at, with about 0.3% declines that's coming in for the benchmark index. But it's coming to the Bank Nifty, a percent decline coming in from there. On the other hand, if you look at the broader end of the markets, both the mid-cap and small-cap indices have been sulking in the red. Mid-cap showcasing a loss of about 1%. Small caps also eking out declines of about 1% itself. But it's clearly the market nervousness has been on, given that the Trump's rhetoric on the Greenland continues to intensify. And of course, there's a brewing trade war tension which is going on between the US and European Union. We'll be watching out for Trump's speech tonight at Davos. Earlier, the scheduled time for Trump's speech was at about 6:30 p.m. For Indian Standard Time. But there's a little bit of a delay for his arrival at Davos, so we'll watch out when that takes place. But for today, that speech is going to be crucial to understand what his way forward is going to be and whether or not there is going to be any tariffs on EU itself. But yes, let's come on the sectoral front, what is doing well and what is not. Nifty Metal Index is the sole index that has been showcasing a bit of a green and positive momentum. 0.5% gains coming in from there. Otherwise, majority of the sectors have been, in the downward trajectory. Nifty Oil and Gas also marginally higher, 0.1% gains that's coming in from there. Otherwise, you can see autos, IT, all of them reeling under pressure. Nifty Pharma Index, PSU banks, you name it, all of them are seeing a decline of about nearly 0.5% or 1% itself. But yes, let's take a quick check of how the gainers and losers look like on the Nifty 50 front. Eternal has been doing well ahead of its Q3 numbers, 5% gains, which is coming in for the food delivery maker. Indigo also showcasing a gain of about 1.5%. Ultratech Cement, Max Health, some of the other gainers on the Nifty 50. However, on the losing end, what's not doing well, that includes the likes of ICICI Bank, 1.5% decline coming in from there. Tata Consumer, Trent, Bharat Electronics and L&T, some of the other laggards on the Nifty 50 front. But yes, let's quickly get on board with our technical expert of the show, Ashish Bahety of ProfitMart Securities, to understand what the last 30 minutes of the trade looks like. Ashish, good afternoon. Nifty continues to decline, even broke the psychological barrier of 25,000 today, though it has recovered from the day's low. But what are you making sense of it? And of course, the levels that you're tracking from here on?
Good afternoon, Lovisha. It's been a painful week, I'll say, followed by, we've seen a followed through selling continuously from last 3 weeks, and there's no respite even at these levels. In the market breadth, which is more of a concerning rather than the index as a whole. Index, we have seen only 5% decline from their all-time high. But however, if you'll see the mid-cap and small-cap index, that have corrected almost 20% plus kind of level, and many of these mid-cap and small-cap stocks have corrected 30 to 40% last in January so far. So that's a bit of a concern with the overall market, and the way FIs are continuously selling. It looks a little bit of alarming. However, yes, market defended its 25,000 zone today, and but how the worst is not over yet. We think it's a temporary respite on the downside. 24,700 looks possible on the chart. So it's still a sell-on rise market till the time we don't cross over 25,400. Every rally can be used as a selling opportunity. On the Bank Nifty front, it's still way above its 200 EMA moving average. But however, if you see the way ICICI corrected after its numbers, it's a bit of a disheartening to see, because that was a stock, or the private banks was this were the one which was giving the support to the Nifty as a whole. But however, we are seeing some selling pressure there in Nifty, Bank Nifty also. So on the downside, we assume that 57,000, 58,000 is possible on the chart. So another 800 points fall can happen in Bank Nifty also. Uh, any dip, any rise can be used as a selling opportunity. On the upside, any one who's short should keep a stop loss of 59,100.
Okay, all right. That's the view for the Nifty and the Bank Nifty index. But yes, India VIX clearly bumped up. Ashish, and yesterday also we did saw it inched up to 12 odd levels. Today it's back above that 13 odd level, so to say. I mean, what would you suggest investors to do at this point of time? I mean, you did mention that it's a sell on rise, but what does the near term indicate in terms of volatility?
So there are two things contributing to India VIX. Yes, the selling pressure is there, and now we are heading. I mean, this is the last next week is the next last week for the 6 series expiry, and after that there's a budget ahead. So both is contributing to the India VIX, and below 10 was a level of India VIX which was absolutely, I'll say, unsustainable. I think 12 to 14 is the zone where VIX should be. And now VIX is reaching to its the upper level of the range that is like the 14 mark. I think there's it's just a bit of recovery in the market and VIX will not cool off from here.
Okay, all right. That's the view coming in from the volatility end. But yes, Nifty Metal Index, the sole sectoral performer at this in this otherwise weak market. What do you make sense of Nifty Metal Index, Ashish? And of course, it's been an outlier for today.
So till the time the geopolitical tensions will be there, and till the time I think the Trump will be in office, metal will be an outperformer as a whole commodity classes, because that's what we assume that there'll be some geopolitical stress anywhere, any part of the world, and the metal will be the first one to get impacted because of that. On the Indian side, most of these metal stocks looks too stressed out. It's not a fresh long is advised at these levels in these charts. However, anybody is holding long, just trail the SL because nobody knows how long these rally can last. And still, even at these levels, there's enough buying happening in these stocks. So, not a fresh buy is recommended, but anybody is holding long, just trail the SL. From the entire metal pack, non-ferrous metals remains our top pick. So stocks like Hindustan Zinc, Nalco, Hindalco, and even Vedanta are the more preferred one compared to the Tata Steel and JSW.
Okay, all right. Non-ferrous names is something that you're watching out for. What about the defensives, Ashish? I mean, usually in a weak market like this, they are the ones that investors usually flock to, FMCG, pharma for that matter. I mean, how does this chart structure look like for them?
So at least they are holding up. They've not. There's not much of the selling or shorting happening in these stocks. Most of these farm FMCG stocks, and ahead of the budget, it's good that these stocks are not giving up all their gains. So if you see HUL and even Dabur and Britannia, most of them are trading close to their 20 daily exponential moving average. However, if we'll see other than these pharma, other these FMCG names, many of the capital goods have like tanked badly into this market. So FMCG is still a go-to counter where to hide in this market. Top pick remains HUL and Britannia from the sector.
Okay, all right. HUL and Britannia from FMCG. All right, that's the view from the defensive pack. But yes, one particular stock that has been gaining today ahead of its results, that's your Eternal. 5% gains coming in for the counter. And of course, brokerages have been estimating that the revenue and the profit would grow on a sequential basis. And margins is something that is that they'll be watching out for. Ashish, how are you placed here for Zomato? And of course, how does this structure look like going ahead?
See, the stock already corrected a lot from the recent highs of, I think in October it made a 360, stock slipped back to almost 270 zone. And so there's a bit of reversal or a short covering happening here. Yesterday it was in a huge pressure. And the good part is stock reversed back very nicely from the strong support area of 270. It looks a good buy on the chart. However, because of the market sentiment, overall market sentiment, we are not recommending a buy here. But if the market recovers a bit, if the Nifty comes in green, probably Eternal would be a preferred pick to go on the long side.
Okay, all right. That's the view coming in for Eternal. But we'll watch out for how the Q3 numbers pan out. In just a bit, we'll be getting on how the company has performed for the December quarter. But yes, let's move on and talk about Credit Access Grameen, because the stock has been buzzing as of now. 8% gains coming in for the counter, largely after brokerages have remained bullish on its strong December quarter results. If you look at by brokerage notes, HSBC has upgraded the stock to buy from an earlier rating of hold. They've even raised the target price, and they said that the third quarter performance was underscored and highlighted by the sharp margin expansion and a decline in provisions. Even CLSA has upgraded the stock to buy from an earlier rating of hold, stating that the share of the new products in its retail finance could be higher than 15% this year. Ashish, the stock definitely has seen a good breakout today on the back of the good results and good brokerages note. Do you expect this rally to sustain going ahead?
Certainly, I mean, in this market where everything, good high quality pedigree stocks are falling, this stock is outperformed, and there's a good buying interest even at these levels. If you see the volume, which is like surpassed, it's almost 10x of the average daily volume. We are hopeful that the stock may even inch up to 1450 to 1500 kind of a zone. So another 100 to 150 points rally is possible in this stock. So anybody is holding long should just trail the SL to 1320. On the upside, there's a strong stock may head up to 1450 kind of level.
All right, 1450 is the level that we need to watch out for the counter. But yes, let's talk about another stock. That's your Kalyan Jewellers. The stock definitely is seeing a sharp fall today of about 12%. And now it has extended the loss to about the 8th trading session itself. So in all of these 8 days, the stock has already declined by about 22%. And out of the 13 trading sessions of this year, the stock has declined in 10 of them. Ashish, what's your view? Sharp fall. And in the past 1 month, the stock has already declined by about 18%.
So there's a huge pressure in the stock. I mean, despite taking the lowest up in today's trading session, stock slide further, and the way it looks on the charts, that stock may head up to 360 kind of a level. So a recommendation is not to attempt any sort of buy the dip kind of a strategy here, not to catch the falling knife. The stock looks clearly under the control of the bears right now. On the downside, 360 is possible. So anybody who's short should trail the SL to 407 zone.
Okay, all right. That's the view for Kalyan Jewellers. We'll watch out how the stock behaves in the upcoming sessions. Definitely, the structure looks weak at this point of time. But yes, another stock which has been doing well in this weak market is your Suryodaya Small Finance Bank. The stock has been marginally higher, given that the company has said that they are planning to enter the gold loan segment as a part of its plan to expand the secured lending space. Now, the bank has already started offering the product in Maharashtra, and they plan to extend it to other states in different phases. And they've said that this move aims to increase the share of collateral-backed loans in its portfolio and diversify its asset mix. But yes, today it's marginally higher, Ashish, but in the past 5 days, the stock has exhibited a weakness, 4% decline. So what's your view going ahead?
So stock took a strong support near its 200 daily exponential moving average. And if we zoom out a chart a bit, I mean, last 3 to 4 months, stock always took a support near 135 level. So this time itself, you will see the reversal or the buying interest was shown at these levels. On the upside, yes, there's resistance on the 148 level. So if stock surpasses 148, we may see a good rally up to 160, 170, 160, 165 kind of a level. Long can be initiated here by keeping a stop loss of 132.
All right, 160 is the target, and of course 132 can be the next stop loss for this particular counter. All right, something to watch out. But yes, let's move on and talk about CET. The stock is seeing a fall right now, almost near its day's low. 5% downtick coming in for the tire maker. We did see a good set of December quarter results, wherein both the profit and revenue grew in strong double digits. And even the management had guided for sustaining this double-digit growth in the domestic market for the near term. But the counter has seen a bit of a loss. Brokerages have also remained quite bullish. They've raised the EPS estimates for FY27 and FY26 estimated revenue growth also. But the stock is seeing a sharp breakdown today. Ashish, what do you make sense of the fall? And of course, how does the near term look like for CET?
See, many of these tech companies were showing good strength on the charts. However, C8 was an exceptional. I mean, it was still consolidating uh, in these levels. So yes, after the numbers, there's a bit of reaction, and we assume that the stock may slide up to 33 or may touch up to 3,300 kind of a level. So stock looks weak on the chart. On the downside, 33 is possible. On the upside, one should keep a stop loss of 3,600.
All right, target can be on 3600. That's the view for CET. But yes, let's move on and talk about AU Small Finance Bank. The stock definitely has cooled off from its day's high level. Right now, it's exhibiting a loss of about nearly 1%. But if you look at from the day's high level, the stock has cooled off by about 2% itself. But yes, we did see that the company posted a good set of Q3 numbers, 6% year-on-year rise in net profit. NII grew by about 16% on a year-on-year basis. Margins also expanded by about 25 pips. Brokerages have also remained positive on the counter, but they've shared cautious note on its valuation and provisioning, which is expected on the back of the ECL impact. Ashish, a relative cool-off in the stock today, but do you believe that the structure is positive going ahead?
Yeah, in today's trading session, also stock made an attempt to touch its all-time high, time highest 1,029, and today's high is 1,027. So if you can see in today, overall, the loss from the all-time high is just hardly 2.5%. So the relative strength is there in the stock, and the stock has been outperformer the entire banking index as a whole. So the stock looks good. If there's a bit of market recovery, we may see of new highs in the stock. So this dip can be used as a buying opportunity. On the downside, maintain a stop loss of 960. On the upside, even 1070 can be visible on the chart.
Right, 1070 can also be visible for AU Small Finance Bank. Little bit of a cool off, but good set of numbers. That is what the takeaway is. All right, let's move on and talk about Oberoi Realty because they have not posted a very enthusiastic December quarter numbers, and that is reflected in the stock price today because it's down by about 1.5%. From the day's high level, also the stock has cooled off by 2%, given that Analyst post the Q3 figures have remained quite unenthusiastic. If you look at Motilal Oswal, they've said that the near-term upside in the stock appears quite limited at the current valuation, and the key trigger for a potential re-rating could be a strategic reinvestment of the substantial cash flows which is expected from its completed projects. They've called a neutral rating on the counter, and they've also cut the target price at this point of time. Ashish, what's your view? It's a negative trend for the counter, but not just for Oberoi Realty, but the entire realty stocks have been quite sideways.
Certainly, the entire realty pack is under huge selling pressure, and it's preferred. Shorting opportunity is also available here in this entire sector because the sector tailwind itself is very negative. Uh, Exclusively for the overall realty, I mean, think the weight is falling after yesterday's 8.5% kind of fall. Today also we are seeing a selling pressure or a follow through selling. Stock may slide up to 1460 kind of a level. So another 40 points fall can be expected here in this stock. On the upside, one should keep a stop loss near 1525.
Okay, all right. That's the view coming in for the counter. But yes, let's discuss about another stock in focus. That's your Persistent Systems. The shares have definitely come under pressure, a 1.5% decline, but the stock is attempting to make a recovery from the day's low. And from the day's low itself, the stock has recovered by about 3.5%. But yes, we did see a good set of numbers that came in from the December quarter, and brokerages largely have maintained a constructive view on the company's medium to long term following the December quarter performance. Now, we did see that the AI improvement and AI-led focus that's what had driven its top line performance, and that's what has kept brokerages fairly positive on the counter. Ashish, the stock is pretty much trying to make a recovery from the day's low. Do you believe the near-term sessions could be much more optimistic than today?
Certainly, the entire mid-cap IT is still showing resilience, and there's still strength in most of the mid-cap IT stocks. They're not contributing towards the downside momentum. And after the numbers, the way stock has recovered from the day low, that looks impressive. However, stock is still below its 20-day exponential moving average. So the fresh long can be initiated only after the stock surpasses 6,300 zone. On the upside, 6,500 is also possible once the 6,300 breakout level happens.
Okay, all right. That's the view for Persistent Systems. good sessions could be on the way ahead. That's the cue. But yes, let's talk about Dhanlakshmi Bank, because that stock has been showcasing a decline of about 2% itself. But the company did report a steady set of numbers for the December quarter. Net profit had risen by about 20% on a year-on-year basis. Asset quality has also improved on a sequential basis. On the other hand, net interest income, NII, has also increased by about 20% on a year-on-year basis. But the stock continues to remain under pressure. Ashish, what does the near term indicate? Because so far in the past 1 month also, the stock has exhibited a negative trend.
So yeah, the stock is under pressure, and if you'll see, stock is retesting its almost 4 or 5 months lows. And if this gets broken in 24 or 20, we may see even stock sliding back to 21 and a half kind of a level. So one should remain cautious here. Don't try to attempt or catch any falling knife here, or don't try to buy the dip here in this particular stock. On the upside, there's a limitation of, or there's a strong resistance near the 2550 zone.
Okay, all right, 2550 zone. That's the view on Dhanlakshmi Bank. We'll watch out the stock. But yes, let's talk about Muthoot Finance. The stock had hit a new high today in this otherwise subdued market, but right now it's cooled off from its day's high level with about 3% drop at this point of time. Now, this also comes ahead of its expectations of healthy earnings. And in the past 5 months, we have seen that the stock has already skyrocketed by about 50%. If you look at the brokerage note that came out by Kotak, they expect the Muthoot's loan book to grow in the October to December quarter to remain strong at about 10% on a quarter-on-quarter basis, following sharp 20% sequential rise in the gold prices. Ashish, what's your view? And of course, the next target levels that we can watch out for Muthoot Finance?
It's one of the strongest chart in the entire NBFC space, and because of the material prices surge, it's been a clear beneficiary because the gold prices surge. On the upside, we assume that if the market recovers or market even consolidate at these levels, we may see 4100 kind of a level. So another 200 points rally is possible in Muthoot Finance even from these levels. On the downside, one should keep a stop loss near 3850.
Okay, all right. 3850 can be the next stop loss for Muthoot Finance. But yes, let's talk about Hindustan Zinc. The stock is clearly up. It's hit a fresh 52-week high level today of about 700 rupees at this point of time. The stock is also trading with about 3% gains. And in the past 3 trading sessions, we have seen that the stock has rallied by about 10 to 11% after the company reflected a strong December quarter. Ashish, what's your view? Of course, you did mention that you've been bullish on the non-ferrous metals, but from a target levels and of course from the support zone also, what are you watching out for the Hindustan Zinc?
See, it's just touched another strong zone of 700, which is a psychological level. And even at these levels, if you'll see, the call writers are getting the squeeze at 700. So we assume that if the short squeeze happens by the call writer, the stock may head up to 740 to 760 kind of a level. So any dip can be used as a buying opportunity, but not fresh long is advised at these levels.
Okay, all right. That's the view for Hindustan Zinc, something that we need to watch out for. But yes, let's talk about Rallis India, how this particular stock has been doing, and let's take a quick check of that, because we did see that the stock had declined by about you can see that the stock had declined in today's trading session, but it has recovered from its day's low, and right now it's up by about 2.5% itself. But yes, we did see a mixed December quarter. The drag on the bottom line was due to the provisions which was there for the new labor code, and the net profit had slumped by about 81% on a year-on-year basis, but revenue had grown by about 19%. But yes, in the past 1 month, the stock has exhibited a negative trend of about 15% decline. Ashish, can we see a further fall, or is there a bit of a consolidation and there's a recovery mode on for Rallis India?
See, there's most of the chemical stocks, agrochemical stocks did a kind of a short pre-budget kind of a rally, and we've seen rallies going up to 280 kind of a level. But however, we think it's more of a fizzled out. The entire rally got fizzled out, and on the downside, even 220 is possible on the chart. So the chart looks weak. On the downside, 220 is possible. On the upside, there's a strong resistance near 242 zone, so one should keep a stop loss there.
Okay, all right. That's the view for Rallis India. But yes, let's talk about SRF also, and let's see how the stock has been behaving, given that the company's management in its post-earnings conference call did say that they have been facing some pressure from the Chinese competitors across some of its core product categories. Now, what the management has been saying that the tariff uncertainty in the US market may continue to create some short-term volatility in the fluorochemical space, and that is why the stock has been weighing down. Ashish, coming to you, sharp breakdown today. What's the next support zone for SRF?
So yes, in this week itself, stock is down by 12%, and today's trading session stock is down by almost 8%. There's a strong support area from near 2550 kind of a level. So another 125 point of fall is possible in the stock because probably this is the first week where the market, otherwise the stock was in a good uptrend. So probably this is the first week, I'll say, on a weekly side, the stock has shown some sort of reversal. So another 125 point kind of a fall is possible on this chart. So any pullback can be used as a shorting opportunity here.
Okay, all right. That's the view for SRF. But yes, let's move on and talk about Reliance Industries because we did have a positive brokerage note that came in from CLSA where they've raised the target price to about 1800 rupees. Now, what the brokerage wrote in its note is that the listing of the Geo by mid 2026 may turn out to be a key event for the company this year, and they expect some potential growth in the quick commerce and the FMCG and the media businesses, which offer value at this point of time. However, the brokerage has cut down its multiples for the new energy business, and they've also trimmed the retail business value to an implied 10% below its equity value of the stake sale. Ashish, of course, the stock has been, started this month on a tepid note itself. What do you expect the next levels to be? And of course, how does ROI look like for the near-term perspective?
See, it's contributing positively for the Nifty today, and this month itself, we've seen a stock making all-time high, and the entire Nifty fall was actually initiated by when the Reliance started tanking. So yes, it's too early to say the stock has made a base near 1400. However, for a long-term investor, not from the trading perspective, but from the purely investment perspective, stock looks really attractive at these valuations because from the above, it is already corrected 220 points. So from investor who's willing to invest or stay invested for at least 6 months to a year, stock looks impressive at these valuation at these levels. On the downside, maintain a stop loss near today's low, that is 1370.
Okay, all right. That's the view for Reliance Industries, and stock clearly has made a comeback from the day's low itself. But yes, sir, let's move on and talk about India Mart, Indimesh. The stock has been doing well, 6% gains coming in for the counter, given that the investors have reacted positively to the company's third quarter performance. We also had a brokerage note that by JM Financial, where they believe that the consolidated collections in the December quarter is marginally ahead of its estimates of 16%, and that's the reason why they have maintained a buy rating on the counter. Ashish, good movement today for India Mart. Do you believe the gains could sustain going ahead?
See, the stock has already corrected sharply from its recent highs, which it made somewhere in the July 2025. And from that zone, stock has already corrected almost 20-25% kind of a level. So yes, we expect this can be a pullback can sustain, and stock may see up to 2380 kind of a level. So another 100-point rally is possible on the stock. On the downside, maintain a stop loss of 2230 in the stock.
Okay, all right. That's the view for India Mart. But yes, let's take a check of how the last rates are panning out. Definitely, Nifty has clawed back to above that 25,000 mark, but still, it's the third day of consecutive decline for the Nifty 50 benchmark index. 65 points decline coming in for the benchmark, 0.2% declines coming in for Nifty 50. Sensex has also declined by about 200 points. 0.3% decline for Sensex 2. Nifty Midcap Index, however, showing a sharper cut of about 600 points, whereas Bank Nifty also showcasing a cut of about 650 points. So yes, all in all, the markets have remained quite nervous given that entire trade dispute which is going on between EU and US. The geopolitical tensions have also triggered a sharp sell-off. Not just that, but of course, rupee hitting a record low due to the persistent FI outflows have also kept the markets on the edge. But yes, apart from that, let's take a quick check of how the mid cap and small caps have closed. Mid caps closing with about nearly a percent decline. Small caps also with about 0.7% decline. India VIX has settled above that 13 odd levels. And from a sectoral perspective, metal index is the one which has been the outlier for the market today with about 0.5% gains. Nifty auto index, however, sulking in the trade, 0.2% declines coming in from there. IT also under pressure with about 0.3% decline. Nifty realty, Nifty pharma index, all of them sulking in the trade with about 0.5% decline. On the other hand, if you look at Nifty oil and gas, that has also seemed a bit of an it's bucking the trend today with about 0.4% gain. But yes, let's take a look at how the gainers and losers have panned out for the markets today. If you look at the gainers list, Eternal, clearly the outlier for today, 5% gains coming in for the food delivery maker. Indigo also sustaining the gains with about 1%. Max Healthcare also doing well, given that we have seen a good momentum that came in for the healthcare and the pharma pack, and as a result of which Max Health has also done well. Metal stocks have been an outlier today, and that's why you can see Hindalco, JSW Steel, both of them topping the Nifty 50 gainers list. But yes, what is not done well in the market is your ICICI Bank, once again sulking in the trade with about 2% decline, given that the street has been, underimpressed with its December quarter earnings, and since then, ICICI Bank has been a drag on the markets. Trent also not doing well, a 1.5% decline coming in from there. Tata Consumer with about 2% decline. Yesterday, Tata Consumer was one of the top Nifty gainers. Today, it's seeing a bit of a pullback. Bharat Electronics also with about 1.5% decline. HDFC Life and Axis Bank, some of the other losers on the Nifty 50. But yes, let's talk about Indigo more, because the stock has been one of the top Nifty gainers. Right now, the stock has been, it has settled with about 1% gains. Ashish, how would you see the movement on the counter, given that we've already seen that it started the year on a tepid note?
See, I think whatever the worst was possible for the Indigo, it has already happened, and we're seeing the price is now consolidating or clearly attempting to make a base near 4,700 to 4,800 kind of a zone where we have seen a good buying interest in this stock. So this stock was an outperformer for at least 3 years back to back in a row from 2023 to 2025. 23, 24, 25. It's in 3 years. Good stock has given a fabulous return. So yes, this fall can be used as a buying opportunity here for the long-term investors. No short-term trading is advised here, but yes, for this long-term investor, by keeping a stop loss near 4750, one can go long for the perspective of at least 3 months to a year.
All right, that's the view for Indigo, definitely settled in the green today. But yes, let's take your top picks of the hour today also in this market sell-off. Ashish, anything that you're liking right now?
So other than metal, we are not liking anything. But however, on the metal side, only the non-ferrous metal can be attempted here. So what we prefer is Vedanta, which is looking good on the charts. The stock has corrected a bit in the recent momentum. Even yesterday, we've seen a bit of correction. So one can go long here by keeping a stop loss of 665. On the upside, 700 is possible.
Okay, all right. That's the view coming in. Metals is something that you're betting on in this tepid market as of now. All right. Thank you, Ashish. With that, we have to let you go, but thank you for joining us. All right, it's the third day of sell-off for the markets, and of course, in just the 2 days, we have seen that Nifty and Sensex have slipped below major averages. But yes, Nifty did slip below that psychological barrier of about 25,000 in today's trading session. But yes, it's clawed back above that, and we did see that Nifty has ended slightly with about flat, but with a negative bias. Even so to say for Sensex also, it's recovered from the day's low, but still ended in the red as of now. Some of the key factors that have contributed to the market's decline, that includes the likes of your geopolitical tensions, that global markets have been witnessing a risk-off mode, given that the US president stance on Greenland doesn't seem to change. His tariff threats against the 8 European nations and his firm anti-Trump posture has been emerging from Europe, and which is why we did see a risk-off mood across the equity markets, not just here, but across from the globe also. Even we did see that globally the stock markets were down, and the flight to the safety of safe havens, for instance, your gold and silver was quite up, because in today's trading session also we did see gold and silver finally once again hitting new record highs. And there is no clarity on how the situation is going to evolve. And that's the reason which has kept the markets nervous at this point of time, because we did see India VIX also edging up. But yes, from the global cues, we did see that the Wall Street has posted one of its worst session yesterday since the April's crash last year. And the volatility has also reached one of the highest levels since November of the previous year itself. Not just that, but rupee at record low, 91.7. That is where the rupee has settled against the US dollar amid the persistent global fund outflows from the domestic equity markets. Now, the Indian rupee has also reacted to the unwinding of yen carry trade, given that yields on the Japanese long-dated government securities have been trading at multi-decade highs amid the political uncertainty. We did see that the Japanese leader had called for a snap election, and since then, the 30 and 40-year tenors have spiked up, and which is why it was also reflected in the US markets also. But not just that, but FII sell-off, like I was talking, FPIs continue to be net sellers, and for this entire month, they have been net sellers from the equity markets. But yes, so, let's quickly go across to understand how the market looks like for the long term and what's the way ahead. Joining me is Rakesh, Vyas, CIO and Portfolio Manager at Quest Investment. Rakesh, I mean, this week has been pretty much painful. Nifty is already down over 2%. What's your reading of the markets and what is your outlook ahead?
Thanks so much for having me here. You are right. I mean, as against the expectation that this year is going to be much better than what it was last year, the start has been slightly rocky. But I think if you look at largely from the internals perspective in terms of how the corporate earnings are likely to shape up or already started to reflect on some of the earnings that came about, we still seems to be on a path where improvement is very much visible. So I think this probably is a market wherein a lot of uncertainty related to global issues, etc., is allowing us to look at many quality companies available at a much reasonable valuations now. So from a slightly longer term perspective, even from 12 month to 24 month, I think it's a good market to look at in terms of where we can actually increase our exposure across a few sectors that we have been fairly more positive on. Generally are actually financial services and consumer discretionary, and that's a space where we still believe that there are reasonable good bets available in the market.
Okay. But Rakesh, FIIs, they have been selling aggressively. How much longer can we wait before, we see a structural change in their flows?
Yeah, so I think FIs to begin with, they started selling because India earnings actually started to disappoint. For almost 2 years now, the earning growth have been very tepid, and historically FIs have always found opportunities or invested in places where growth has been fairly more visible. And even in this time around in last 2 years or so, if you look at the places where FIs investment have actually increased globally, are either in the AI trades where growth rates are much higher, or are in specific markets where even the earning growth is probably similar to what we were presenting, but were available at much cheaper valuations. But as I believe that for next 4 to 6 quarters, the overall earning for the Indian corporate starts to improve. We'll probably see movement back of FIs into Indian equities. Of course, the rupee depreciation in near term is also a spoiler because in dollar terms they are actually getting impacted in terms of their returns. But in my view, given that the current account and the fiscal deficit, all of that will start to look reasonably well consolidated from here on. Rupee probably will find its feet at around maybe between 90 and 92 levels. And from there on, as the corporate earnings starts to kick back, I believe FIs will start to look at India more favorably. However, it will still take maybe another 3 6 months for this view to get found out.
Okay. Rakesh, what's your early reading of the Q3 results so far? Because so far we have had IT, and of course some of the major private lenders have also reported their third quarter numbers.
Yes, I think if you look at X of the labor code impact, if you look at the numbers now, they are probably broadly in line. I mean, we haven't seen any major disappointments in the numbers, so to say. I would rather go out and say that in many cases we are actually seeing some positive surprises on the operational metrics. So, for example, in many cases there was a fear that, especially for private lenders, we will probably see compression of net interest margin even in this particular quarter. But the numbers that came out so far start to reflect that banks have been able to manage it very, very well through their deposit repricing, saving bank account rate reduction, CRR cut, etc. So I believe the early traction, not only for lenders but also in the IT, seems to be favorably placed. Of course, for IT services, in many pockets, growth is missing, and I think it was broadly expected that growth will probably still be very, very moderate, even in third and fourth quarter. So I don't think that we have seen any major disappointments in the numbers so far, barring very far and few, especially on the consumer discretionary side, so to say, which is very unlike, because it was believed that given all the impetus that has been put up by both the central government and RBI, the consumer discretionary spend will see actually some demand traction. In small ticket to mid ticket items, we still haven't seen that meaningful traction, but I'm still hopeful that as you move forward, those are the pockets that will start to reflect much better earning growth, especially in fourth quarter. But so far, I don't see any major disappointments coming through in the earnings.
Okay, okay. Rakesh, I'll expand on the argument of for the IT services, what you were talking about. I mean, earlier everybody was flocking to this particular sector because they believe that the valuations have been comfortable, the risk-reward ratio is also quite favorable. But after the Q3 results, do you see growth visibility going ahead?
Yeah, so I think I would say that we haven't seen any material change in the growth trajectory yet. Of course, the overall deal wins continue to remain very, very healthy. Especially in terms of the argument around valuation, I would agree with you that you have come to a levels where the dividend yield or the free cash flow yields do provide you some support on valuation. So very unlikely that you will see any major correction in valuations from here on. But for valuation re-rating to happen, a major growth push has to come through. Companies who have been delivering reasonable growth are still finding favors in terms of investor interest. But overall revenue growth trajectory needs to see meaningful improvement before a broad-based rally can come into this sector. The only point is that on margins, given that there is a rupee depreciation against dollar, there will be some cushion and some benefit that can come through, but you also have to look at cross currency in many cases. So there is, on margins, there is some improvement, but larger growth trajectory is still missing. As the visibility starts to improve from execution front, especially from the order wins that have come through in last year or so, will probably lead to some better earning trajectory and maybe slightly better re-rating. But I still believe that you will have to find specific names in this sector to play. It's not going to be a more broad-based yet.
Okay, all right. Selective names from the IT space. All right. Apart from that, from the financial space, what are you liking more? Is it PSU banks or is it private lenders that you're more bullish on?
So yes, we have exposure to PSU banks as well. But in the private lending space, I think earlier we were far more positive on the large private lenders. But incrementally over last 3 to 6 months, we have started to take some money off the large private lenders and move that money into either the small private banks, which are more regional specific, but growing much faster, also been able to manage their NIM trajectory very well, because a larger part of their loan book is still fixed interest rate based, whereas the cost of fund benefit will start to come through for them just like everyone else, and therefore NIM will probably be much better cushioned or improved. And therefore the earning trajectory will be much superior. Valuation that we are paying is reasonably low. For example, we have increased our exposure or entered into companies called City Union Bank. We have been fairly more positive on new private NBFC, Tata Capital. So these are the names that we have recently added, where we believe that the growth trajectory is going to be far superior than the other large private lenders who are still struggling to meaningfully surpass the overall industry level credit growth yet. So if you look at ICICI, HDFC, even Axis, you will only see them, meeting the industry credit growth numbers largely.
Okay, okay, got it. Rakesh, I mean, both your flagship and even the multi-asset funds, they have heavy concentration in the small cap space, but the earnings have been a disappointment, quarter on quarter. Going forward, how are you navigating the scenario?
You are right. I mean, if you look at overall market also for last almost 15 months or so, it's been very challenging market. So although the Nifty and Sensex major benchmarks doesn't reflect the pain, but pain actually lies in the broader market. So for example, BSE 500, the median return for last calendar year is actually -4%, which means that there is a lot of value loss that has happened across the board. Our exposure to small caps by mechanism is also having its own impact on the overall portfolio in general. But our bets are still more concentrated around the themes that I talked about, which is around consumer discretionary, so to say, or even in the private lending space, where we believe that at least going into next 4 to 6 quarters, the earning trajectory will be far superior than what we have seen in last 1 to 2 years. And as that come through, the ask valuations today is actually very reasonable. So in many cases, we are finding some of these names that we continue to hold even more attractive. Therefore, we'll probably be adding into those positions as well. I think over next 4 quarters or so, we believe that small caps as a space, after going through the near-term pain, will be one of the outperforming space to be.
Okay, okay. Does that make us, on a strong trajectory of double-digit growth for at least FY27 estimated earnings?
Yeah, that is true. I mean, if you see right now, so our expectation is that the overall corporate earnings will be between 12 to 14% largely. And the two or three sectors primarily which will be major driver of this earning growth I've already talked about, which is BFSI and maybe the overall consumer discretionary spend. So these are two numbers or two sectors which maybe constitute almost half of the market. And there the visibility remains fairly more stronger. So I think from a cycle where we have continuously seen earnings downgrade on a regular basis for last almost 2 years, we have come to a point where the earning downgrade will actually moderate meaningfully, and we'll probably see this 12-14% earning trajectory going forward. And that's how we are right now position ourselves in terms of our portfolios.
Okay, okay. Rakesh, what about the capital goods? I mean, you've been bullish in this space also. Any pre or post budget rally that you're anticipating, or change in investor conviction you see for this theme?
So if you look at it, I mean, for especially from the government capex, the ability of government to do any meaningful increase in the capex intensity is going to be very difficult, given that they are still on the path of fiscal consolidation. And last 12 months or so, they have actually parted away with a large amount of tax collection through income tax cut as well as GST rationalization, right? So their ability to maneuver more around capex and incremental allocation thereof will be very limited. But they have already done a great job. I mean, if you look at from FY19 to FY24, the central government capex has actually increased from 3.5 lakh crore to 9.5 lakh crore. So that's been a massive number over 5 year period. This year, budgetary allocation is close to 11 lakh crore. I don't think that even for next budget, we'll see any major increase beyond the overall nominal GDP growth in that segment. So we'll be slightly cautious around those, and particularly on specific sector within this infra space, which is actually around road and railways, are where we believe that the growth rates will be much more moderate. Defense may continue to find its favor, but especially on the private capex, there are two, three things that I just want to highlight. One is on the overall power T&D and renewable space, the capex intensity will continue to increase, and especially around power T&D, because that's an area where large number of investment is expected, not just in India but globally also. So that's a space that we remain favorably more placed towards. And I think as you move forward now, given that our hypothesis is the larger part of corporate earnings and the GDP growth will be led by volume growth. and therefore the industry utilizations across various segments will start to improve. It's already inching up gradually. I think as we start to see more visibility of a sustained growth in that volume trajectory, the private capex intensity will actually increase because corporates so far have been actually strengthening their balance sheets over last 4 5 years, not so much invested in capex. But as utilization improve, the capex intensity towards the end of this FY27 fiscal year is when we will see much more announcement coming through, and it will be that will place us well for next 2 to 3 years from that perspective.
Okay, all right. That's what makes you bullish on capital goods. But just one last question before I let you go, Rakesh. Of course, we'll be watching out for Trump's address tonight at the Davos, and definitely on his comments on whether the tariffs would be there on EU also. But do you think that these tariff commentary could be just a temporary volatility factor, or can it structurally alter the global equity risk?
So I think earlier, if you see, I mean, there was very clear indication that Trump would announce something and then backtrack in the initial part of his this second tenure. But over last few months, I think he is actually pulling through his threads, so to say, and there haven't been many reversals yet. So I am not very sure as to how to look at this global uncertainty now, to be honest. But it does look like that he's alienating himself away from a lot of his allies. NATO is supposed to be a great friend of United States, and all this tariff talk, etc., is only going to increase uncertainty, and it will also impact to some extent the global currency markets, the global fixed income markets, and it will have its own repercussions. So I'm not sure as to whether he will pull out of this threat eventually in next week or so. But if he does go through with very high amount of tariffs, then obviously you are entering a zone where most countries in the globe are now facing very large amount of tariffs in US, and it's actually only going to impact majorly the US consumer, who so far has been far more resilient. I think if all of that tariff start to go through into the purchase prices for them, then it's going to have meaningful impact on the consumption power of US consumer, which has been a great strength so far. And also, given all of these issues, there could also be realignment of lot of treasuries, etc., globally, which will also create some amount of uncertainty around US dollar currency and cross currency movement. So these are slightly challenging times, very unpredictable, so to say. I just hope that he probably comes out of this without impacting the overall tariff environment in general. But we'll have to see. Honestly, I am not very clear at this.
That's right. I mean, we watch for more for tonight, and of course the address that we're waiting for. All right, on that note, we have to let you go, Rakesh, but great conversation, and thank you for joining us.
Thank you so much for having me.
All right, that's all we have for this edition of Closing Bell. We'll be back with we will be back with markets tomorrow once again. But yes, we'll be watching out for U.S. President's address at the Davos 2026, wherein he might make remarks on the Greenland issue, and of course, his statements around the European Union is also something that we'll be watching out for, since he's also leading one of the largest delegations there. So, definitely some of the remarks, not just on the tariffs front, but of course how the business perspective he's going to lay out going ahead is something that we'll be keeping an eye out for. But for now, it's a wrap from me. Stay tuned to moneycontrol.com, and we'll be back with more markets tomorrow. Thank you for watching.